People can say they're a fiduciary, and then you need to ask them, who are you a fiduciary to? And again, I know I've said this, but it's important enough to bring it up a second time. Are you a fiduciary to me, the client? Yes. Who else are you a fiduciary to? All right, everybody, welcome back. We are, believe it or not, we're coming up on the end here. We only got a couple left, so I hope you've enjoyed the journey. Episode 12, Chapter 11, Fear number 10, the final fear. The next episode, I'll be talking about more conceptual, fun stuff. So this is kind of the final fear pertaining to the book. So I am your host, Alexander Pushman, author of the book, 10 Fears of Retirement. And, you know, I hope, again, I can't stress enough, I hope you've gotten a lot out of this. You know, a lot of times when I'm working with families and talking to clients, doing, you know, my community stuff, when I go and speak, you know, my goal is always that, you know, somebody takes one thing from what I say. So if you've taken one thing, it's a victory. Even better if you get one or two things every time I'm doing one of these episodes, great. So I hope you've gotten some good stuff. Hopefully it gets you thinking, because in this game of retirement, in this game of financial planning, taking a proactive approach will never, ever hurt you. And half of it is just, again, I'm a broken record, is knowing what's coming, knowing what the rules are, and knowing what your options are, okay? So this chapter is paying off your home and debt, and how those relationships filter in to your retirement picture and the things that you need to know. You know, and I always kind of try to give two pieces of perspective when I talk about anything financial related or retirement related. Number one, what's the math tell us? If our decisions and our information is based on the math, science, and economics, usually that gives us a good look at it. And then we're going to have to go to the second side, which is our personal preference, our, you know, perspectives, our feelings, our emotions on different things. And that's a lot of today's episode, because when we talk about paying off the house and debt, that's a common conversation I'm having. And so I'm going to kind of give you the 101 of debt and paying off the house to start with. So here's some basic principles when you deal with the house, because I think the house is probably the most important thing, something that I'm, again, talking about almost every single person I talk to, unless it's already paid off, we're having this conversation. Usually if it's a couple, you know, one spouse doesn't really have a stake in the game, and the other one's like, no, I want this thing paid off. Why? Well, it's usually an emotional or a goal that they set before they retired and said, hey, I want to have my house paid off by the time I retire. Now, that may or may not be in your best interest. So let me give you some of the tools to help you make that decision. Number one, interest rate matters. When we look at a house payment, and I'll give you some really basic math. If we look at a house payment and let's say that you have an interest rate of, 3%, 2.7, 3.2, basically sub 4%. The math tells me it's actually probably not in your best mathematical interest. Now, again, every single person is unique. Every single person is a little bit different. So what I would say to that is if this is you, again, I'm going to encourage you, sign up to talk to me, set up an appointment on my schedule that is free to you for being a part of this journey with us. If you haven't got your book, sign up to get the book for free. If you want a physical copy, you can go to Amazon and order that bad boy. So make sure you're taking advantage of the consultation with me if you'd like that, if you have questions that you've developed throughout this series. But when it comes to the mortgage, this is really it. Let's just say you have a 3% interest rate and you owe $100,000 on your mortgage. So let's then say on the other side of the fence, we look at your investments and you've averaged 7%. Okay. But you could currently get a money market that pays you 5.2%. Well, the math would tell me if I took that same 100,000, because basically what we'd have to do is we'd take 100K, out of your investments and pay off that mortgage. If they're currently getting worst case scenario 5.2% and it's in a money market, that would tell me that one decision would be basically hurting yourself by 2.2% that year and then compounding years if that rate stayed true. So that would be a bad mathematical financial decision for the simple fact that you would be paying off, if you left it in the investment, you'd be paying off that 3% note and profiting 2.2%. Okay. Now, that's the math of it. Now, let's give another example. Hey, Alex, I have an interest rate on my house of 6.1. We might be having a different conversation. Say, hey, it might make sense. Let's get that thing paid off. Why? Because if we went to the most conservative or very low risk to no risk investments, and we're getting 5.2, 5.5, it still makes mathematical interest to take that money and pay off that 6.1% interest rate. So that's the first step, is understand your interest rate, understand your monthly income that you have coming in between Social Securities, pensions, IRAs, part-time work, whatever it is, versus what that mortgage note is. Because again, think about it like this as well. So that's the basics of it. What's your interest rate? What's your monthly payment? How much do you owe? And then making a decision based on those important mathematical, variables. The other thing you have to consider is once you pay that off, you're not going to get your write-offs anymore. So if you're big on the write-offs that you get from your mortgage interest, and that's a big deal for taxes, the taxes need to be in consideration to make that decision. Well, what about also, in addition to, let's say you do pay off the house, you get it done, it made sense. Remember, you still have to pay your taxes, your property taxes, right? Your home, on your house, there are property taxes you have to be aware of. That is a widely ranged number based on where you live. County, state to state, county to county, city to city. You got to be aware of what your taxes are because you're still going to have to pay that. And then if you don't have a mortgage, you're going to be writing a check and paying those out of pocket out of your bank. So just be aware of that relationship. So when it comes to the house, again, the first thing is we have to understand the math. And there's families out there who we've looked at the math. We're like, hey, hands down, this is a slam dunk to keep it. Your interest rate's at 2.7. We got a fixed rate at 5.4 or 5.2 or whatever that number is. And it's a slam dunk mathematically. But the family still makes the decision to pay it off. Why? Again, usually one person leads a charge, but it could be two. I just had a goal that by the time I retired, it was paid off. Alex, in order for me to sleep at night, I don't want this house payment hovering over my head. It's going to reduce our monthly expenses by $1,500 a month. Whatever the reasoning is, there are real reasons, and I deal with them all the time. I've seen it go both ways. So oftentimes what I lean into, and again, this is experience talking of doing this for a very long time, is sometimes we have a compromise or a hybrid. Hey, the math says 100% don't do it, but our opinion and our emotion is 100% to do it for one reason or another. Maybe we find something in the middle where we pay half of that number off, and over the next 5 years or 2 years or 3 years, we pay the rest of it off, and it still works for both sides of the fence. Hey, I can sleep at night, I'm peace of mind with that, but it also made better financial sense. So I always will lean into that. I'm always looking for, hey, is there a compromise or is it just is what it is? So paying off the home, that's a conversation you'd be having. And I will say this because it happens, and I've had people say this to me. They'll come in for a second opinion. They'll get referred to me, one way or another. They'll come across my name in my situation. Hey, Alex, want to talk to you. Hey, my financial advisor won't talk to me about this stuff. Keep in mind, and I've said this before in past episodes, depending on the company they work for, that advisor, some bigger companies won't allow financial planners to talk about taxes, to talk about this type of stuff, debt. Why? Because it's a liability. If a financial planner gets it wrong, it's on them. It's on their organization. So a lot of companies look at it as like, hey, that's a liability. Don't get into that. Even though it's in your best interest to have these conversations, that's where we get into that fiduciary conversation. People can say they're a fiduciary, and then you need to ask them, who are you a fiduciary to? And again, I know I've said this, but it's important enough to bring it up a second time, third time for that matter, but are you a fiduciary to me, the client? Yes. Who else are you a fiduciary to? Well, I have a board of directors. I have shareholders. Understand, is there a conflict of interest with that individual's fiduciary relationship? Again, I am biased to my own belief system and opinion, but it's because of experience and understanding this at a deep, deep level. I am what's called an independent fiduciary. I don't have a board. I don't have shareholders. I technically don't have a boss other than the family I'm working with on their accounts. That's important to me. I'm set up like that by design. So understand when you get into these conversations, you want to have somebody in your team, somebody who's an expert to you, who can give you these non-biased opinions, who's not afraid to have conversations about these different things outside of the stock market. Is the stock market important? Yes. Are your investments important? Absolutely. Is your Social Security claiming important? Yeah. Some companies won't even let their advisors talk about Social Security. I feel bad for these folks. They want to. A lot of them want to, but they're not allowed to. So make sure you understand that relationship and you're having a good open conversation, because a lot of the time when I get folks coming over to work with me, they're making that transition to retirement. You get one shot to do it right. And they want to make sure they have somebody who they can talk about everything with, from Social Security to taxes. Again, I'm not a CPA, right? I'm not doing your tax returns, but I know enough about the tax laws, because that's my job, to be able to give you good input on how it affects your retirement and or how it doesn't. So Social Security, taxes, pensions, mortgage payoff, debt consolidation, investments, income, all this stuff should be conversations that are very rich that you are having with your financial professional. And again, I feel bad because a lot of folks who are in the financial industry aren't allowed to talk about some of these things because, the powers that be don't allow them to. And again, this isn't popular, or maybe they're just lazy and they don't want to do it, right? Again, I've said this before, financial planners get paid whether they're making adjustments to your accounts or not. Most of the time, unless it's like a broker dealer and you're picking the stuff and they get paid per transaction or something. So understanding, hey, how people get paid, understanding their fiduciary relationships, understanding how that dynamic works is very important for you, the person about to make some of the most important financial and lifestyle decisions you've ever made. So I always encourage it, seek to understand, seek the education, and make those informed choices because they're massive, okay? All right, so that kind of deals with the paying off the house. So it's also similar with like debt 101. Same exact math and process and formula, if you will. Okay, I got this credit card. Credit card debt's the worst. Why? Because a lot of people on credit card, unless it's like that introductory rate, hey, 0% APR for 1 year. Phenomenal. You're not paying any interest, right? But then at the end of that year, where's your interest rate go to? Make sure you're aware. It's going to be on your statement. It's going to be on your website. Most of these credit cards are somewhere between like 23 and 29% interest. I've seen some as high as 31. That's important. If you got $5,000 sitting in an account that's paying 29% interest rate, and you have, another $5 or $10,000 outside of it sitting in the bank getting 0, it probably makes sense to take that 5 and pay that thing off, or take that 10 and whatever that number is, pay it off. So credit card debt is dangerous. Be aware of your interest rate, but all debt, it's the same conversation. Whether it's an auto loan, whether it's a HELOC, whether it's a personal loan, understand your interest rate, understand your cash positions, understand your investment positions. Is it non-qualified, IRA, Roth? What's the taxes if I do go pay this debt off? These are all things that factor into it, but those interest rates are kings. The second thing I would bring into the debt conversation is what's the balance? There's two ways we kind of go about it. One, you're looking at the interest rate. Two, you're looking at the balance. I got 3 loans. One's a credit card, one's personal, one's a HELOC, whatever. 26% interest rate, and it has a $2,000 balance. One is a $10,000 balance, but it's only at a 5% interest rate. And the third one is $7,000 and it's 11%. I'm just making this up. If it was me, it would be easy pickings here. Why? I'm going to take that high interest rate and that low number, and I'm going to kill that one first. The next thing I need to do is, okay, am I going at the higher balance or the lower balance based on that interest rate? So, consolidating accounts, paying off the smaller values quickly. So if you're somebody who's got a bunch of debt and there's like 6, 7 accounts, maybe you start with the ones that are small first, but keep in mind what the interest rate is. It's either value of the account and or interest rate, and make sure you understand both sides of that fence on who you pay off first, how quickly you can get rid of a debt. Again, if you got 6 of them and you can pay 2 of them off right away, maybe you do that, even if it's an lower interest rate, just to come bring that number down and start getting organized. So debt's a complicated one, but that is something, unfortunately, we have to consider. So, getting into the concept all right, we talked about mortgages, we talked about debt, and again, it's not fusing atoms. There's some great stuff out there, but again, if this is something you want to make very unique to you, please let me know. So on the other side of that fence, what I do want to talk about is budgeting. I know I'm a broken record. Budget, income plan. There's a budget before retirement and there's a budget after retirement. And I talked about this in the last episode. Leading up to your retirement, you're somebody who wants to have 50 grand in the bank and you're a year out and currently you only have, 26. Well, what you need to do is you need to save about $2,000 a month to get to 50 by the time you retire. So think about your cash, think about what you want to have in the bank that again helps you sleep at night. You're not having that monthly paycheck. Make sure you're considering how much, maybe you have a little bit more in the bank or the money market or the cash when you first retire because you're not getting that every 2 weeks paycheck and it will do something to you psychologically. I've said this before, but there's a financial conversation in retirement, there's an emotional and there's a psychological, and they all affect people differently. But the more you're aware, the more you think about it, the more you plan, the easier that transition will be. So budgeting up to retirement and then having a very good idea on what your budget looks like after retirement. There's always going to be curveballs. That's part of it. You got to be okay with this is a moving target. Retirement is a moving target. Taxes are a moving target. Your investments, the economy, the stock market, moving target. Understand it. It's not always going to be consistent. Can you do things like create an annuity? A deferred annuity where it pays you out every month, X forever. Yeah, you can do those things. And maybe that's a portion of your retirement. Not often I like to see people do the whole thing, but you can do different things to give yourself peace of mind. One of them is having a budget leading up to retirement, and one of them is your post-retirement budget. And again, that income need should reflect very closely to each other, but make sure you have enough in cash. Make sure you have an investment plan. And so kind of leading off and finishing off like that planning piece, I've said this before, but what's a comprehensive plan? It's having an income or distribution plan. It's having an investment plan where you understand what the minimum rate of return you need is, linked with how much money you're going to spend a month, which tells you how much risk you should or should not take based on your unique situation. What investment tools are going to be the best fit? How much are you paying in fees? You need to understand this stuff. And then a tax plan. Hey, is there any opportunities for me to minimize taxes on my investments? Roth, IRA, non-qualified, et cetera, et cetera. Life insurance. Do you have some and you're paying too much? Do you need it? Oftentimes, again, you don't need it. I don't want to generalize, but a lot of times people are paying for insurance they don't need because somebody has some wrong perspective on what they do and don't need, and they spend way more money than they need to. Your trust, your will, your deeds, your power of attorneys, all these things. Is that something you understand? Do you need some basic education? And do you have it completed? Usually when people retire, I always encourage them, hey, have that done in the first year or two, just in case. So if you can have all 5 pieces of your retirement covered and they're all talking to each other, that is a good retirement plan. So when I talk about these 10 fears, this didn't just come from me making it up. It came from sitting down with thousands of families and identifying trends of the things that people bring up to me most. Like I told you before, and I did a whole episode on it, running out of money is always the number one. Taxes. Not being a burden on your family. Hey, Alex, should I pay off my house? These fears are very normal. They're the most identified I've at least experienced in my career. And so it's not about just being aware of what the concern and the fear is. This isn't to scare you. It's to say, hey, here's some of the fears that I see, and then here's some of the solutions. Those solutions might look different from your neighbor. Net worth matters, debt matters, medical, longevity matters. So there's never, and again, I've said this, but there's no general rule for retirement. That's why it's such a complicated area. But make sure you do yourself the due diligence. Please, please, please. If it's not me, that's fine. But if you're comfortable, I promise you, I've never had somebody walk out of my process of walking through people through this, giving them all the data, giving them all the reports, giving them all the answers. If I can help you, I'll shoot you straight. If I can't, I'll shoot you straight. But I would highly encourage you to have these things completed. If you've already retired, it's never too late. Just make sure you're doing it. Make sure you're getting these answers. You might be running towards a brick wall and you have no idea how far that brick wall is ahead of you. It could be 2 feet, or it could be 50 yards, or it could be 2 miles. But make sure you know where your path leads, because a lot of this stuff, good for us, is based on mathematics. Okay? That's the beauty. Math doesn't lie. So I want to encourage you again, take advantage of this. There's not going to be any costs. There's not any gimmicks. There's no hidden stuff. But please, 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 if you have questions, if you have needs, reach out to me, reach out to my team. We're here to support you. And I truly hope you've gotten a lot out of these 10 fears. We got one more podcast in the hopper, but I hope this helps you give a little bit of perspective on that debt and that home payoff conversation, because it's a normal one, and everybody's different. So again, I hope you got some good stuff. I hope you enjoyed this episode, short and sweet, and we'll see you in the next episode to cover the last chapter of the book, 10 Fears of Retirement. Again, I'm Alexander Pushman, and I hope you're getting a good stuff out of this. And again, I hope you're enjoying it. So thank you. Have a wonderful rest of your day, and God bless you.